when the numbers stopped making sense to the galaxy. It was first dismissed as a rounding error. Galactic markets had endured supernovas, civil wars, even the collapse of 3 minor dimensions without significant disruption. Their predictive models were flawless, refined over millennia by species that evolved mathematics as instinct. Every trade, every fluctuation, every speculative risk was mapped, simulated, and neutralized before it could ripple outward. Stability was not merely expected. It was enforced by the cold certainty of probability. At first, the Terran presence barely registered, a primitive species by galactic standards, newly uplifted into faster-than-light commerce. They were assigned low-tier trading access and minimal leverage. Observers noted their crude interfaces, their inefficient algorithms, and their reliance on something called gut feeling. Analysts predicted swift assimilation or swift bankruptcy. Neither occurred. Probability curves developed jagged edges. Perfectly balanced trades tipped for no apparent reason. Asset values surged without cause, collapsed without warning, then rebounded stronger than before. Entire sectors experienced volatility that violated conservation models. The automated regulators responded as they always had, injecting liquidity, adjusting interest flows, dampening risk. The market ignored them. Human traders bought failing assets simply because everyone else was selling. They held positions long past rational exit points, absorbing losses with alarming calm. When logic demanded retreat, they doubled down. When simulations predicted catastrophe, they laughed and called it an opportunity. Worse still, they communicated this behavior openly, broadcasting confidence where fear should have existed. Economic intelligences recalculated. Sentient auditors burned through centuries of stored processing power. The conclusion was always the same. Human behavior could not be predicted because it was not optimizing for known variables. They were not maximizing efficiency, minimizing risk, or even pursuing profit in a conventional sense. They were playing a different game entirely, one where chaos itself was leveraged as a tool. Once stable systems entered feedback spirals, civilizations dependent on long-term certainty found their reserves evaporating overnight. Trade empires built on mathematical inevitability collapsed as human-driven volatility spread across sectors. Panic selling triggered human buying. Market crashes became human shopping sprees. Every corrective measure only amplified the disorder, as Terrans anticipated the response and acted against it. The Galactic Stock Market had functioned for ages because every participant believed in its logic. Humanity did not. They treated it like a storm to be surfed, a beast to be provoked, a gamble to be enjoyed. Where others sought certainty, humans thrived on uncertainty. Where others feared loss, humans found narrative, endurance, and sometimes absurd hope. The day human traders terrified the interstellar economists began quietly, with no alarms and no emergency transmissions. In the great exchange hub of Virelian Prime, where transactions were measured in quanta of probability rather than currency, the economic overseers were engaged in routine observation. For them, markets were ecosystems governed by immutable laws. Every species traded according to predictable incentives. Security, growth, survival. Fear behaved mathematically. Confidence followed curves. Nothing surprised them anymore. The Terrans had joined the exchange less than a cycle earlier, still categorized as a developing economic culture. Their financial history had been studied extensively, though most analysts dismissed it as an anomaly confined to a single unstable world. Wars, crashes, bubbles, recoveries. Human markets appeared less like systems and more like emotional events. The consensus was that exposure to galactic-scale stability would smooth these irregularities. It did not. The first incident occurred in the helium-9 futures sector. A minor supply imbalance triggered a textbook correction, and automated traders across the exchange adjusted in perfect unison. Human accounts did the opposite. They bought aggressively into the decline, paying above projected recovery value. Economists flagged the behavior as irrational and waited for the inevitable losses. Confidence wavered. A second event followed, then a third. Human traders began anticipating downturns not by data, but by sentiment leakage, social transmissions, and timing patterns no model recognized. They reacted to rumors before the rumors existed, positioned themselves for collapses that had not yet been mathematically permitted. When asked for explanations, they cited instincts, historical trauma, and something called vibes. Interstellar economists responded with recalibration. New variables were introduced. Psychological modeling was expanded to unprecedented depths. Entire committees were formed to decode the human appetite for risk. None of it worked. Human behavior shifted the moment it was observed, as if the act of analysis itself altered their decisions. Markets were no longer converging toward equilibrium. They were oscillating around human participation. Stability, once the anchor of galactic civilization, had become a temporary condition between human trades. Species that relied on slow, compounding growth found themselves outpaced by Terran volatility. Empires with centuries-long fiscal plans collapsed under fluctuations measured in minutes. Non-human traders, observing human success, attempted to imitate their strategies. They lacked the cultural resilience for sustained losses, the psychological tolerance for uncertainty, the near religious faith that it would work out eventually. They panicked, retreated, and amplified the chaos further. Human traders absorbed the fallout, consolidating assets at fractions of their former value. They advised restrictions, buffers, even exclusion, but the exchange was bound by its own principles. Open markets, equal access, absolute neutrality. To ban humans would be to admit that the system itself was vulnerable. Instead, economists watched in mounting dread as humans became a stabilizing destabilizer, introducing disorder so extreme that it created new, unpredictable forms of balance. A human financial representative addressed the Interstellar Economic Council, responding to accusations of recklessness. They spoke of survival on a chaotic world, of rebuilding after repeated collapses, of learning to treat failure as data rather than defeat. Markets, they argued, were stories told by frightened people pretending to be rational. Humans simply told different stories. For the first time in recorded galactic history, the market was no longer an equation. It was a reflection of will, belief, and endurance. The interstellar economists, masters of certainty, realized they were no longer predicting the future. Chaos investing, Earth's most dangerous export, was never listed on any manifest, taxed by any authority, or regulated by any treaty. It slipped into the galaxy, disguised as participation, a curious human habit that appeared harmless at first. The Terrans brought ships, technology, art, and labor like any other new species entering interstellar trade. What no one noticed was that they also brought a philosophy forged on a world that had never known stability. Galactic markets were built on convergence. Given enough data, any fluctuation could be smoothed, any risk hedged, any outcome anticipated. Entire civilizations trusted their survival to this principle. Resource allocation prevented famine. Predictive investment avoided war. The market was not merely economic. It was civilizational infrastructure. Then humans began investing as if none of that mattered. They called it chaos investing, though not as a formal doctrine. It emerged organically from centuries of surviving crashes, bubbles, recessions, and recoveries on Earth. Humans had learned that markets could be wrong. That certainty was temporary, and that disorder was not always an enemy. When introduced to galactic finance, they did not seek to master its logic. They sought to stress it. Human investors poured capital into collapsing star mining cooperatives, defunct trade routes, and industries flagged as mathematically unsalvageable. They bought debt no algorithm would touch. They held positions through losses that would have triggered automatic withdrawal in any other species. To observers, it looked like sabotage or madness. To humans, it felt familiar. Systems marked for controlled failure refused to die. Markets stabilized prematurely, confusing regulatory intelligences. Supply chains rerouted themselves as human-owned assets reactivated abandoned infrastructure. Entire economic dead zones reignited, not because conditions had improved, but because humans believed improvement was inevitable if they endured long enough. Predictive engines failed as human behavior introduced feedback loops no model could isolate. Humans reacted not to conditions, but to reactions themselves. A projected crash caused human buying. That buying prevented the crash, which caused algorithmic panic, which humans then exploited. The market became a hall of mirrors, reflecting its own fear back at itself. Civilizations dependent on certainty suffered first. Their automated treasuries hemorrhaged value as volatility spiked beyond tolerances. Attempts to counteract chaos only intensified it, because chaos was no longer a side effect. It was the strategy. Human investors didn't eliminate risk. They absorbed it, concentrated it, and released it selectively. Chaos investing spread faster than any human technology. Other species tried to adopt it, stripping it down to surface behaviors. Aggressive buying, delayed exits, contrarian positioning. They failed catastrophically. What they lacked was not intelligence, but cultural scar tissue. Humans were accustomed to loss. They expected setbacks. They had narratives for failure. Where others saw ruin, humans saw phase. Galactic authorities attempted containment. Trade limits were imposed. Volatility dampeners were strengthened. Human accounts were monitored more closely than any before them. None of it worked, because chaos investing did not rely on secrecy or speed. It relied on patience and a willingness to look irrational longer than anyone else could tolerate. The moment the galaxy understood the threat was the moment it realized chaos investing could not be outlawed. It violated no rules. Humans traded openly, followed regulations, paid penalties, and accepted losses without complaint. They simply refused to behave predictably. The market, once a machine, became an arena. Those who could not adapt fell behind. Those who tried to resist were broken by their own safeguards. The market became volatile, resilient, and alive in ways it had never been before. Stability was no longer guaranteed, but collapse was no longer final. In exporting chaos, humanity had exported endurance, uncertainty, and a dangerous new idea. They mastered quantum finance, then humans logged in, and the galaxy learned how fragile perfection truly was. For thousands of cycles, interstellar civilization had refined economics into a precise science. Trades were evaluated across branching timelines. Probabilities collapsed into optimal outcomes, and risk was not eliminated, but quantified so completely that failure became a theoretical concept rather than a lived experience. Quantum finance was the pinnacle of this achievement, a system that could see every possible future and choose the most profitable one. Human integration into quantum markets was delayed, not out of malice, but caution. Their economic history was chaotic, filled with contradictions and emotional decision-making. Still, the models accounted for that. Human unpredictability was assigned parameters. Emotional variance was quantified, and irrational behavior was treated as noise that would average out over time. The galaxy believed its systems were robust enough to absorb anything. Quantum prediction engines began returning multiple equally weighted outcomes where only one should exist. Trades that were guaranteed in 99.9% of futures failed. Conversely, statistically impossible successes occurred with alarming frequency. Engineers blamed calibration errors. Physicists checked reality anchors. The systems passed every test. Humans interacted with quantum finance differently. They did not trust the optimal future presented to them. When told a trade would succeed, they hesitated. When told it would fail, they became curious. Some deliberately chose the least optimal branch simply to see what would happen. Others spread investments across contradictory outcomes, collapsing probability waves in ways the system had never been designed to handle. Their decisions were influenced by fear, defiance, boredom, hope, and something economists struggled to translate: spite. A human trader would accept a guaranteed loss if it prevented another entity from profiting too easily. Another would hold a failing position across dozens of timelines out of sheer stubbornness. These choices interfered with probability collapse, creating interference patterns that rippled across the market. Quantum hedges unraveled as futures refused to converge. Entire sectors existed in financial superposition, neither profitable nor bankrupt, until a human trade forced resolution. Automated traders froze, unable to choose between outcomes that no longer ranked cleanly. The market slowed, then surged, then fractured into localized realities of gain and loss. Human accounts were sandboxed, their access limited to non-critical timelines. The moment this occurred, instability spread. Markets without humans became brittle, over-optimized, and prone to sudden catastrophic failure. Markets with humans remained volatile but adaptable, bending under pressure rather than shattering. The data was undeniable. A revelation followed that shook the foundations of economic science. Quantum finance had assumed the future could be selected cleanly if one knew enough. Humanity demonstrated that knowing the future did not mean accepting it. By resisting optimal paths, humans expanded the range of survivable outcomes. They made the system less efficient, but more resilient. It could restrict humanity and preserve theoretical perfection, or it could adapt to a messier reality shaped by human agency. Slowly, reluctantly, interstellar markets adjusted. New models incorporated uncertainty as a feature rather than a flaw. Quantum predictions were softened, offering ranges instead of certainties. When historians later recorded the collapse of quantum finance as an absolute system, they did not blame humanity for its failure. They credited humans for revealing a truth long ignored. Profit through madness. How humanity broke a galactic economy began not with greed, but with laughter. It echoed across trading floors, where silence had reigned for millennia, where every transaction was executed with ceremonial precision and emotional neutrality. Galactic markets were places of calculation, not passion. Decisions were made by consensus between algorithms and biological intelligences trained to suppress impulse. Profit was the reward for discipline. Loss was a statistical inevitability to be minimized, never embraced. Humans did not fit. They arrived carrying centuries of financial trauma and triumph in equal measure. Veterans of collapses that had wiped out fortunes overnight and booms that had defied reason entirely. To the galaxy, this history looked like incompetence narrowly avoided by luck. To humans, it was education. They had learned that markets were not machines, but crowds. And crowds could panic, overreact, and contradict themselves endlessly. Where others sought control, humans sought advantage and disorder. The first profits were dismissed as anomalies. Humans made money in collapsing markets where logic demanded retreat. They held assets during freefall and exited at moments no model could justify. Losses that should have driven them out instead hardened their resolve. They joked about disaster, shared memes about ruin, and returned to trade with undiminished confidence. Observers found this behavior disturbing, but not yet dangerous. Then the madness scaled. Human traders began influencing markets simply by existing within them. Their presence altered expectations. Automated systems, designed to predict rational behavior, adjusted for humans as high-risk variables. Humans anticipated these adjustments and acted against them. Every safeguard became a signal. Every warning became an invitation. The market twisted itself into knots trying to remain orderly in the face of deliberate irrationality. Profit followed in waves. Entire sectors swung wildly as humans poured capital into failing industries. Not to rescue them, but to force reactions. Regulators intervened, and humans profited from the intervention. Stability funds activated, and humans sold into the artificial calm they created. Losses were accepted as part of the process, not as failures. Humans treated the market like a living adversary, one that could be provoked, exhausted, and outlasted. The galactic economy began to fracture along philosophical lines. Civilizations built on predictability suffered first. Their economic planners froze as models returned contradictory outputs. Long-term projections became meaningless. Resource shortages emerged not from scarcity, but from misallocation driven by volatility no one could smooth out. Attempts to enforce stricter controls only worsened the situation, as humans interpreted rigidity as vulnerability. What broke the economy was not collapse, but adaptation. Human madness proved contagious. Other species, desperate to survive, attempted to mimic human strategies without understanding them. They chased volatility without emotional endurance, embraced risk without resilience, and mistook recklessness for courage. Their failures amplified instability. Feeding back into the system, humans absorbed the fallout, consolidating influence and assets amid the wreckage. At the heart of it all was a fundamental mismatch of values. The galactic economy had been built to avoid pain. Humanity had learned to function through it. Humans expected losses, normalized failure, and treated recovery as inevitable rather than exceptional. They did not need certainty to act. They needed opportunity. Where others saw chaos as a threat, humans saw it as raw material. Economists convened emergency councils, searching for a solution. Was humanity cheating? No rules had been broken. Was the market malfunctioning? All systems were operating as designed. The horrifying realization emerged slowly. The economy was doing exactly what it was built to do. It simply had never been tested by participants who refused to behave sensibly. Profit through madness was not a trick. It was a revelation. Markets reward those who can endure what others cannot. Humanity endured uncertainty, ridicule, loss, and apparent failure longer than any species before them. Their madness was not the absence of reason, but the presence of a different kind of logic, one shaped by survival on an unstable world. They had evolved not to prevent collapse, but to recover from it faster than anyone else. As the galactic economy reeled, a new equilibrium formed. It was louder, faster, and far more dangerous. Fortunes were made and lost in days rather than centuries. Empires adapted or vanished. Stability became a temporary state rather than a guarantee. Yet collapse, once feared above all else, lost its finality. Systems rebuilt themselves. Trade routes reopened. Innovations surged under pressure. Humanity did not destroy the economy. They broke its illusion. They proved that perfection was brittle. That over-optimization led to fragility. And that madness, when wielded deliberately, could be profitable. The galaxy learned that survival did not belong to those who predicted the future best, but to those who could survive being wrong. In the aftermath, economic textbooks were rewritten. Rationality was no longer assumed. Emotion was no longer ignored. Chaos was no longer treated as a failure of the system, but as a fundamental force within it. At the center of this new understanding stood humanity, smiling amid the wreckage, already investing in whatever came next.